A shocking development out of China sending shockwaves around the globe. Is this a tipping point we've all feared? Stay tuned. Now, let's over to Bloomberg, where we picked today's story up with a headline. As China's private factory gauge plunges to the weakest since 2022. And one of the challenges we've been facing in the global economy is that going into the trade war, everything was slowing down. Many people wondering where the bottom was, but once the trade war hit, manufacturing turned up, and many people said demand is back and in a big way, and we warned it was likely to reverse, and what we're seeing out of China is now an indication that the tipping point is here. The Cakes and Manufacturing Purchasing Managers Index fell to 48.3 in May from 50.4 the prior month, indicating that it's now back in contraction. And this is a major issue because the headline PMI for the manufacturing sector in China focuses on large businesses, where the Cakes and Manufacturing PMI focuses on small and mid-sized businesses. So you can see the key point here is that in any economic slowdown, whether it's in manufacturing, services, or at the consumer level, it always affects the smallest first. What we're seeing here is small businesses saying, look, we can't keep pace. This trade war is hurting us, and we're back in a contraction. The problem is, unlike the large manufacturers who have access to credit and cash and have employees they can shed to increase their cash flow, small businesses are risking the fact that they could be out of business, and what this means is it's going to affect not just those in China, but small businesses all over the world, including right here at home. Manufacturing supply and demand decline, driven by overseas demand, pointing right at the United States. The downward pressure on the economy has significantly intensified compared to preceding periods, meaning the pain for small and mid-sized businesses is only getting worse. And we could look back here in the U.S. and we've seen small business confidence data. It soared after the election because small businesses needed to see demand increase. They needed prices to go up because they've been hurting at the margin for years. And then what happened as the trade war intensified is confidence went straight down. And that means what we're likely to see from a lot of small businesses, they're going to be forced to lay people off. But the risk is many of them could fail. This is what we're seeing now happening at China's manufacturers. And this is a huge problem because what happens there will spread all over the world. The impact from U.S. tariffs is mostly on smaller exporters with a hit to employment, while a direct impact on large corporations and overall exports will likely be more limited given their much more diversified business profiles. And again, there is the risk because once people start losing their job, particularly in a period where the global economy is slowing down, their opportunity to re-enter the workforce is rather low. And the more people you see on unemployment, their spending goes down, and next thing you know, we're plunging right into a recession. That's the best case. The more reality, at least for China, is you're going to see an all-out financial crisis, one that could see property prices crash and their banks go insolvent. The surprise deterioration in manufacturing highlights the need for more support for the government to strengthen consumption and offset shocks to external demand. And this happens anytime you see an economy slow down. Everybody starts to point to government and say, look, you need to deficit spend. You need to pump money into the economy to put the brakes on this downtrend. But I want you to think back over the last couple weeks. What's happened right here at home is that Moody's came out and they've downgraded U.S. debt. And what that means is it makes a clear statement to politicians that you can't keep running massive deficits. You need to get your fiscal house in order. And this is something we warned about, that there would be another downturn. The problem is, due to all the excess spending post-pandemic, well, what it meant was governments would be unable to respond. Now, we know China has some latitude to fund their economy, but we've also noted in the past it hasn't worked and unlikely to work this time. At the height of tensions and with the U.S. last month, the central bank delivered cuts to its policy rate and the reserve requirement ratio, which determines the amount of cash lenders must set aside in reserves. And so the initial response here is go to the central bank, lower interest rates, give the banks more latitude to lend, but it never actually works. There's a reason why that happens, and yet when it does, you see the economy continue to trend down instead of shooting higher. But something that should have jumped in big time since since April. Well, that's your trading account. Remember, we put this trade on uranium, and that was up 35.7%. That's right, that trade got stopped out, and this is real trade, a real live return. That to our CTA Timer Pro subscribers that we teach each and every day how to trade against the machines. Now, if you want to learn how to do that, grab the links in the description below. Use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. Because when we talk about the relationship between the economy and central bankers, it's very clear why cutting rates and increasing lending doesn't work. Let's take a look at some U.S. data here, and we'll overlay the federal funds rate in blue with the unemployment rate in red. And what do you see going back to the late 1980s? The Fed is cutting rates, but the problem is the unemployment rate rises. You can see there's no impact on the economy from lower rates. You can see it happen during the dot-com bubble, very clearly during the financial crisis. And right now you see no real change to the unemployment rate, even though the Fed cut rates. And now you think about why that happens. And well, there's one very simple reason. People that have a job can't get a loan. If you don't believe me, try it. Go to the bank if you don't have work, and they'll tell you absolutely not. You've got to have income, and that's the problem when people are out of work and the economy is slowing down. The last thing banks want to do is lend because they care about one thing, and that's getting their money back. Now let's turn back to China as holiday spending shrinks as consumer sentiment stays weak. Now, last time we talked about sentiment in China, many people said it's very different there than here is in the U.S., but that's not the case at all, because when consumers lose confidence about the economy, it means they're losing confidence about their job, their finances, and their ability to get another job if they lost it. When that happens, their spending goes down. Chinese consumers just the same as U.S. consumers. The data suggests that Chinese households have remained vigilant against splurging amid job and income uncertainties. Very clearly, you're seeing, again, small and mid-sized businesses go back in contraction here. Again, a major problem for China. The economy is grappling with domestic woes such as a property slump, deflation, and trade tensions with the U.S. And this is a problem, again, because when people look at the economy and they think about spending money in the real economy, if you're a Chinese consumer, you're seeing manufacturing slowing down. Again, you're seeing property values continuing to slump. You're not seeing demand there. And when that happens, of course, many people realize it's only a matter of time before mass unemployment hits. And next thing you know, it's game over for China's economy, and that's why exactly what's happening there. Sentiment goes down, spending goes down. Same thing with American consumers. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. There are risks to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to Monetary Metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through Monetary Metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. Let's take a look at real retail sales in blue against the University of Michigan Consumer Sentiment Survey in red. Again, going back to U.S. data because you can see consumer behavior, it's the same all across the globe. Let's go back to the mid-90s. What happens, you see a little bit of a downturn in sentiment, and consumers, again, worried about their finance, they cut their spending. You see real retail sales on the decline. You see the same relationship going into the dot-com bubble, because what happened back then? Inflation was rising, incomes were not keeping pace, confidence fell as the labor market started to unwind, and that meant spending goes down. And remember, it's all about confidence and then spending. You see confidence drop, spending drop. You see that happen right around 2021. And now look, you can see the spending here in the U.S., based on the latest confidence data, is poised to outright collapse. And one of the challenges, of course, we look at right now is many people said, look, we're not going to see further disinflation. There's no chance of deflation. But when you think about all the front running of the tariffs, all the inventory building here, what is setting up is an inventory recession. We are going to see pockets of deflation at some point. And the challenge is when you have too much inventory and a lack of demand, you go right back to China. You look at their factories. Again, those small and mid-sized manufacturers are saying, look, we're back in contraction. It has everything to do with the fact demand is plunging. And if we see, of course, demand in the U.S. going down right alongside that, and this is how we know, again, retail sales are going to plunge because people are cooking at home at the highest level since the start of the pandemic, just according to Campbell's Soup. More meals at home could mean people are eating out less, showing that Americans are tightening their belts. And that's exactly what it means, because one of the best economic statistics out there is when people go out to eat. Because when you see consumers happy and excited about their finances, they love nothing more than to go out and eat. But the first thing you can cut when things get tight, that's eating out. And that's a good indicator. If you're out eating, look at the restaurants, look at how busy they are. Ask your servers what's going on, and they'll tell you if things are slowing or speeding up. And right now it's very clear here in the United States, things indeed are slowing down. And that could spell bad news for GDP, as 2/3 of which relies on consumer spending. Remember, we've talked about this before. U.S. consumers have a lot of power in the economy. The moment they feel uncertain, the moment they believe their finances are going to get worse and they cut their spending, the U.S. economy heads straight down. It can also underscore the souring outlook of everyday Americans on the national economy. And here you see the University of Michigan's Consumer Sentiment Index last month fell to one of the lowest levels on record. And that tells us very clearly where the U.S. economy is likely to head, because right now, many consumers are worried about losing their job. They know demand isn't there. They know their hours are going to get cut. And then after that, they're going to see their jobs go. But let's talk about sentiment against real food sales, that is, as we look at advanced retail sales of retail, trade, and food services, that now shown in blue. And you can see when confidence goes down, the immediate reaction is people stop eating out. And you can see that throughout every cycle, which makes it an excellent statistic to gauge the overall health of the economy, because when things turn around, the first thing people do when there's money in their pocket, well, they eat out. And right now, what is this telling us at the restaurant level is things are going to get a lot worse, and that means a lot of service workers are going to find their ways right on the unemployment line. They're going to see their hours get cut. So again, we look back and we talk about how manufacturing leads the services sector. You can get a very clear picture of this. And even though only about 8% of U.S. jobs are tied to manufacturing, it's the amount of money those employees make, it's the amount of business those manufacturers spend in the economy. You can see why it leads the services sector to the downside. And it also means inflation's coming down as well. Let's turn to the Eurozone, where we see inflation falls to a cooler than expected 1.9% in May, below the ECB's target, indicating, well, you know what that means? They're going to be cutting rates. But inflation isn't just about prices going up. It's a great barometer of demand, because businesses cannot continue to raise prices if nobody's buying. What you're seeing here in Europe is the indication that prices are too high, incomes are too low, and consumer demand is plunging. May's steep decline in services inflation to its lowest level in more than 3 years confirms that the previous month's jump was just an Easter-related blip, and that the downward trend in services inflation remains on track, just as we've been suggesting. But May's inflation data strengthened the case for another cut at the following meeting in July. There is little doubt that the ECB will cut rates, but what I want you to see here is that when central banks cut rates and you see more and more people hit the unemployment line, it has absolutely no real effect on the economy. And this is one of the challenges of central banking, is they follow lag data and they make decisions well after we see downturns begin. That's why policy has absolutely no effect. Of course, we can only wonder what would happen if central bankers use real-time data and try to anticipate the direction of the economy. Maybe things would work out better, but what we do know is when demand goes down and inflation goes down, well, it means things at the factory level are about to go down as well. And we see U.S. factory orders plunged in April here in the U.S., that after surging in March, again, we warned that this front running of tariffs was going to come to an end. Well, that end is here, and it's now. Tariff front-running dominated the largest month-over-month rise since July of 2020, and now U.S. factory orders tumbled 3.7% in April, worse than what all the experts said. And also the 4.3% rise in March, well, that was revised down to 3.4% month-over-month. And while the month-over-month drop was the biggest since January 2024, it dragged the headline orders down to just 0.9% year over year. When you strip out the more volatile transportation sector, core factory orders fell for the second straight month, down 0.5% month over month. So what we're seeing here, we go right back to consumer sentiment. It's dropping because the economy is slowing and people are worried about their jobs. They're cutting their spending at the same time. What are you seeing? Massive inventory overhangs. When you have that case, you don't need to order at the factory level. Now factory demand goes down. We come right back to the cakes and PMI, and you can see why some of these small and mid-sized manufacturers in China are struggling back in contraction. It means layoffs are going to hit all over the world, and soon. And let's take a look at the relationship now between the University of Michigan Consumer Sentiment Survey in red against manufacturers' new orders of durable goods in blue. And you can see again, the relationship makes perfect sense. Sentiment drops, spending drops, and that means new orders you see in blue drop right alongside. You can see the relationship going into the dot-com bubble. They were right in sync going into the financial crisis. You can see around 2015 what happened. We were facing a global synchronized recession. New order demand entered contraction. We see the consumers briefly excited about that. Sentiment drop, further pushing, of course, demand down. We see a little bit of it going into the pandemic, and then coming out of the pandemic, well, right around 2022, you see confidence plunging, new orders down, and now what is a likely outcome here is confidence plunges. Although it's very clear what's coming, a lot of workers know that now that demand is gone and the backlogs have almost been completed, what that means is there are going to be a lot of people hitting the unemployment line. And we can now turn right back to the Eurozone, where we find out a lot of people are indeed, at least from Volkswagen, about to lose their job. And Volkswagen says 20,000 workers agree to early departures as Europe's largest car maker is in the process of reducing production capacity and headcount in Germany due to rising costs and weaker demand in Europe and the rapid rise of Chinese competitors. And there's a key point. Everybody believed coming out of the pandemic that we were facing a new normal, that consumers, after a long decade of consumption, had pent up demand and were going to drive the economy going forward. We said, look, that's not the case. Had everything to do with pandemic stimulus. And once that was gone, we were going to see the global economy reset lower. What China is saying is, look, we did reset lower, but now we're at a tipping point that's going to take us down a whole nother level. And that's the risk. When you artificially pump up an economy, you don't go back to baseline, you go somewhere below that. Let's take a look at this next chart of what's happening in Germany with Volkswagen and why it's going to spread to manufacturers, not just in China, but all over the world. Now let's overlay capacity utilization in red against manufacturers' new orders of durable goods in blue. And what we can see is Volkswagen mentioned that capacity utilization was going down. Well, that's an exact response to the fact that new orders are going down. So when new orders drop, less of your factory is being utilized, and you can see the very strong relationship between these two. So we already know, based on the confidence data, that new orders are likely to go down as sales on the retail side drop. And that means, of course, capacity utilization is going to drop, and in turn, that's going to lead to rising unemployment. Here you can see now we're going to overlay the unemployment rate in blue, and you can see as capacity falls going into the 91 recession, what happens? The unemployment rate rises. You can see the same thing happens going to the dot-com bubble, the financial crisis, and now what are we facing? Exactly what the sentiment surveys are saying, exactly what small manufacturers in China are warning us about, and that is demand is weakening, and that tells us we're at a tipping point, one that can plunge the entire world, not just into a recession, but an all-out financial crisis. But even if that happens, it doesn't mean you can't make money in the markets. Let's talk about that trade on uranium. Now, that came out to our CTA Timer Pro subscribers, and what we do each and every day is we look at the machine positioning across the broad equity, bond, currency, and commodity markets. And we do that because these machines trade momentum, and they push a large amount of money into the market in a very short period of time. And what we want to do is position our subscribers ahead of their buying. Now, we have an advantage because we run historical overlay against machine positioning, and that increases our probability of knowing when they're about to be big buyers. But we further back tested all of our signals so we know which signals are likely to lead to high probability returns, and that data is published every day on our hot list. But in addition to getting the hot list, you also get the machine positioning across all the broad sectors. Now you get the report, you get all the tradable signals. I review all the trades and give you my opinions on the best ones I think you should take. I give you risk control levels and update them on a regular basis. We give you a full tracking of all of our open trades and returns. We give you a weekly update, and here's the best part. We're so confident that you can make money trading our report, we don't want you to put out a dime for your first 30 days. That's right. Grab the links in the description below. Use the coupon codes for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.